A $3,000 credit card discount can become a tax bill after you already paid the settlement. If you owed $7,000, settled for $4,000, and the creditor forgave the other $3,000, the IRS may treat that missing $3,000 like income. That can shrink your refund, create a balance due, or hit months later when you thought the account was finally dead. So here's the map. Why forgiven credit card debt can be taxable, why Form 1099-C can arrive after the payoff, and when insolvency or bankruptcy may reduce the real cost. Debt settlement is sold like a clean ending. Pay less than you owe, stop the calls, start over. The ad makes it feel like you cut a chain, but real life can add a second invoice behind the first one. The creditor can erase part of the balance, report that erased amount to the IRS, and suddenly the government is not asking whether you are still stressed. It is asking whether someone canceled a debt you legally owed. Take Maya. She's 36, works in customer support outside Phoenix, and carried a card balance through a job gap, a car repair, and the regular little emergencies that somehow always cost $400. Her balance grows to $7,000. The minimum payment barely moves it because interest gets paid first. So she negotiates. The card company agrees to take $4,000 as a lump sum. Maya drains savings, sells a few things, skips a trip, and pays it. The account is marked settled. She finally feels lighter. Then January comes. In the mail or buried in an online tax portal, she gets Form 1099-C. Box 2 says $3,000. That $3,000 is not a paycheck, it's not a bonus, it's not in her checking account, it is the part of the debt she no longer has to repay. And under the tax rules, canceled debt is often treated as income unless an exclusion applies. Now Maya has a tax problem attached to the debt problem. The balance went down, the tax return got more complicated, and if she ignores the form, the IRS may already have a matching copy from the creditor. That's the trap. The creditor balance can disappear while a tax balance appears somewhere else. The basic tax logic is simple, even if it feels like a prank. When you borrow on a credit card, you do not pay income tax on the borrowed money because you're supposed to pay it back. The loan is not income because there's an obligation on the other side. But if that obligation gets canceled, the tax system says your financial position improved. That sounds ridiculous when you are still rebuilding, but that is the rule. Canceled credit card debt can be included in gross income unless you qualify for a legal exclusion. This is where the $600 number matters, but not the way people think. Creditors are generally required to report canceled debt of $600 or more on Form 1099-C. That does not mean $599 is automatically tax-free. The reporting rule and the tax rule are different. The $600 threshold is about when the creditor generally has to send the form. Smaller canceled amounts can still be taxable, depending on the facts. So if someone says you only need to worry if you get a form, be careful. The form is evidence, it is not the source of the tax rule. The real questions are, how much debt was canceled, when was it canceled, and do you qualify for a reason to exclude some or all of it? Timing is where people get blindsided. A settlement feels finished when you make the payoff. You send the money, you get confirmation, maybe the account shows zero. Emotionally, you are done. But the tax reporting clock does not care about your emotional finish line. The lender has its own cancellation event, internal processing, and year-end reporting. Form 1099-C commonly shows up in January after the settlement closes. Box 1 shows the cancellation date, which may not be the date you stopped paying, the date the collector called, or the day you felt free. That's how someone settles a card in July, starts rebuilding in August, and gets a tax form months later, like a financial jump scare. The creditor also files the form with the IRS. Ignoring it can create a mismatch. The IRS computer sees income reported under your Social Security number. Your return does not address it. Later, a notice shows up asking why the numbers do not match, and that notice may arrive after you already used your refund, moved apartments, changed jobs, or finally stopped thinking about that card. The paperwork is boring. The consequences are not. If a 1099-C shows up, read it like a warning label. Box 1 is the cancellation date.
That matters because exclusions like insolvency are measured immediately before the debt was canceled. Box 2 is the canceled debt amount. This is the number the IRS may expect you to address.
Not always the final taxable number, but the number that starts the conversation. Box 3 can show interest included in the canceled amount. For most personal credit card debt, you did not deduct that interest, but it can matter if the debt connects to business or another deductible interest situation. Box 4 describes the debt. Make sure it matches the account you settled. Box 5 says whether you were personally liable. For normal credit cards, you usually were. The creditor could pursue you personally for repayment. That is different from some loan situations where recovery is limited to collateral. Do not toss the form into a tax folder and hope software understands your settlement call from 9 months ago. Compare it to the settlement letter, final statement, and payoff confirmation. Did you settle one card or multiple cards? Does the amount make sense? Did the creditor report the right account and year? If the amount, date, or account description looks wrong, contact the creditor and request a corrected form. Keep notes: date of call, person you spoke with, what they said, and any reference number. Documentation is annoying when everything is fine. It is gold when a tax notice shows up. Now put numbers on the pane. If $3,000 of credit card debt is canceled and you were in the 22% federal bracket, the federal tax effect could be around $660 before state tax and before the rest of your return changes anything. That is not a prediction. Your real result depends on taxable income, deductions, credits, state rules, and exclusions, but it shows the scale. If $10,000 is canceled, a 22% federal bracket could mean about $2,200 before state tax. If you expected a $1,500 refund, that refund could disappear and turn into a bill. This is the part the glossy debt ads leave out. The settlement savings are real. Settling $7,000 for $4,000 is a real reduction, but the full $3,000 difference may not be spendable relief if part of it comes back as tax. So the better question is not, how much will the creditor forgive? The better question is, after tax, fees, and timing, what does this settlement actually save me? If a settlement company charges a fee, add that. If you stopped paying while waiting for settlement, add late fees, credit damage, collection risk, and stress. If the settlement creates taxable canceled debt, add a tax reserve. This is not to scare you away from settlement. Sometimes settlement is the most realistic option. If the choice is an impossible balance or a negotiated reset, settlement can be useful. But you need the all-in math, not the marketing math. Here's the household version. You settle a $9,000 card for $5,500. That sounds like a $3,500 win. If your combined federal and state tax effect is around 25%, that forgiven $3,500 could cost about $875. If the settlement company also charges fees, the win shrinks again. Still a win? Maybe, but now you can plan for the real number instead of getting ambushed. This is where insolvency matters. Insolvency means your total liabilities were greater than the fair market value of your total assets immediately before the debt was canceled. In normal person English, right before the creditor forgave the debt, did you owe more than everything you owned was worth? Not after the settlement, not 6 months later, not "I felt broke." The measurement point is immediately before the cancellation event. Here's a clean example. Right before a $10,000 debt is canceled, your assets are worth $7,000. That includes bank balances, a car, retirement accounts, furniture, and anything else with fair market value. Your liabilities are $11,000. That includes credit cards, medical bills, personal loans, student loans, auto loans, and other debts. Assets, $7,000. Liabilities, $11,000. You are insolvent by $4,000. If $10,000 of debt is canceled, insolvency may let you exclude up to $4,000 of canceled debt income. The remaining $6,000 may still be taxable unless another exclusion applies. That detail matters. Insolvency is not always an erase button. It's more like a shield up to the amount you were underwater. To claim it, you generally use Form 982 with your tax return.
That form tells the IRS, yes, debt was canceled, but this amount is excluded under a specific rule. It can also involve reducing tax attributes in some situations, which is why large or messy cases are tax pro territory. The mistake is thinking insolvency means I did not have enough cash. Cash poor is not the same as insolvent. You might have $400 in checking and still not be insolvent if you own a paid-off car, have retirement accounts, and your debts are lower than your total assets. On the other hand, you might have a decent paycheck and still be insolvent if medical debt, credit cards, and loans exceed the realistic value of what you own.
So, before the settlement is finalized, take an insolvency snapshot. Make a simple balance sheet for the date right before cancellation. Use bank statements, credit card statements, loan balances, reasonable vehicle values, retirement balances, home value estimates if you own property, mortgage balances, medical bills, personal loans, and student loans. You are not trying to create a museum-quality appraisal of your entire life. You are preserving reasonable evidence of what your financial position looked like at the key moment. Because 6 months later, memory gets fuzzy. Websites update, account balances change, car values move. The tax form arrives and suddenly you are reconstructing the past with 3 screenshots in panic. Do the boring work while the information is fresh. If you are settling multiple cards, track each one separately. One creditor may cancel $1,200, another may cancel $4,800, another may report in a different month. Each can generate its own 1099-C, and the cancellation dates may not match. Make columns for creditor, original balance, settlement amount, forgiven amount, date paid, expected cancellation date, whether a 1099-C is expected, and where the documents are saved. Then add a tax reserve column. If you do not know your final bracket, use a conservative placeholder. Some people set aside 20 to 30% of the forgiven amount until they can estimate the real return. That does not mean the tax will definitely be that high. Insolvency may reduce it. Credits may change the outcome. State tax varies. But a reserve keeps you from spending every dollar of apparent relief before the tax question is answered. Open a separate savings bucket called settlement tax. If your bank allows sub-accounts, use one. If not, track it manually. Do not leave it blended with grocery money and pretend discipline will win every time. Discipline gets weaker when the tire light comes on and the kid needs new shoes. If the reserve is hard to build, cut specific lines temporarily. Pause the streaming service you forgot you still pay for. Switch a few recurring purchases to cheaper versions. Delay a non-essential upgrade. Use the settlement month as a cleanup month. Because the worst loop is settling a credit card, then paying the tax on the settlement with another credit card. Congratulations, the system has invented debt recycling with paperwork. Bankruptcy is different. Debt discharged in bankruptcy may be excluded from income under a separate rule. That is not the same as insolvency. Insolvency asks, right before cancellation, were your liabilities greater than your assets? Bankruptcy asks, was the debt discharged in a bankruptcy case? Those are different doors. Sometimes the result overlaps, sometimes it does not. And bankruptcy is not a casual tax planning trick. It affects credit, court filings, assets, future borrowing, and legal rights. You need professional advice before treating it like a button you press because a 1099-C looks scary. But if bankruptcy is already part of your situation, do not assume a 1099-C automatically means taxable income. Bring the form to your bankruptcy attorney or tax professional and ask how the discharge should be reported. The same caution applies if the debt is connected to business, farming, real estate, or anything beyond normal personal credit card spending. Additional exclusions may exist, but they are not casual DIY material. Now cover the messy edge case. What if the creditor sends a 1099-C and then still tries to collect? That can happen, and it is confusing because the form suggests cancellation while the collection activity suggests the debt may not actually be gone. If a creditor keeps trying to collect after issuing a 1099-C, verify the situation. Ask whether the debt was canceled, sold, transferred, or reported incorrectly. Request written clarification. Save every letter.
This matters because you are responsible for reporting the correct taxable amount for the correct year, even if the form is late, wrong, or confusing. Also watch the credit report language. Settled for less than full balance can damage your credit differently than paid in full. That is not the tax issue, but it is part of the real settlement cost. If you are choosing between a hardship plan, nonprofit credit counseling, bankruptcy consultation, or settlement, credit impact belongs in the decision. Debt settlement is not automatically bad. Minimum payments on high-interest credit card debt can trap people for years. A negotiated payoff can be rational, but it is not a magic eraser. Before you sign or pay, ask 5 questions. First, what exact amount will be forgiven? Do not accept vague language like substantial savings. You need the original balance, settlement amount, and estimated canceled amount in dollars.
Will the creditor issue Form 1099-C, and for what tax year? They may not give perfect certainty, but ask anyway. You want a paper trail showing you tried to understand the reporting. Third, when is the cancellation event expected to occur? This matters for the insolvency snapshot. If the cancellation date is before or after your payoff date, the balance sheet may need to match that timing. Fourth, can you build a tax reserve before spending the apparent savings? If $5,000 is forgiven, even a rough reserve of $1,000 to $1,500 may prevent April chaos. Maybe your actual tax is lower. Great, then you have emergency savings. But if you reserve nothing, you have no margin. Fifth, do you need a professional before filing? If you were insolvent, had a bankruptcy, settled multiple debts, received a wrong 1099-C, or have business-related debt, pay for advice before you file a wrong return. Cheap tax prep is not cheap if it misses the exclusion that saves you thousands. After settlement, keep the agreement, proof of payment, final account statement, 1099-C, and creditor messages in one folder. Digital is fine. Back it up. Rename files clearly. Creditor name, account last 4 digits, settlement date, amount paid. If you get a corrected form, keep both versions. If you claim insolvency, keep the balance sheet support. Bank statements, debt statements, vehicle value estimates, retirement balances, and anything used to show assets and liabilities immediately before cancellation. You are building a defense file before anyone attacks. Here is the final reframe. Debt settlement can be a powerful reset, but the payoff is not just the amount you wire to the creditor. The payoff includes the tax form, the timing, the reserve, the documentation, and the exclusions you may qualify for. If you treat the 1099-C as a random surprise, the system controls the timing. If you plan for it before settlement, you control more of the damage. So yes, settle if the numbers work, negotiate hard, get everything in writing. Do not pay from guilt or panic, but before you celebrate the discount, run the after-tax math. Write down the debt, the settlement amount, the likely forgiven amount, the expected 1099-C year, the possible tax reserve, and whether insolvency or bankruptcy might apply. That one page will not make the system fair, it will not make a tax form feel good, it will not magically replace the money you drained to make the collector go away. But it can stop the same debt from surprising you twice. Because the real win is not, I paid less than I owed. The real win is, I know what this costs, I know what forms are coming, and I have a plan before the next bill finds me.